On the other hand, what's also interesting, specifically about small value, international small value, is that investors over decades, and particularly starting with the academics, but also looking at practitioners over the years, what we found is that not all stocks are the same when you're trying to invest your money. And if, for example, if I were to draw the square that represents the entire stock market, and you want to delineate among different stocks, well, professionals don't really do it based on sectors and the media, the way the media does it. But the first delineation was based on the size of the company, that you have these large companies that are mature, well established, and they could be in the US, they could be abroad. And there's a very different economic dynamic relative to smaller companies that are also participating in the market, but they're not as big. So, just as an example, you can look at McDonald's as being the poster child for the large companies, and Shake Shack is a smaller company. It's still a big company, trades in the market, but certainly a different track record, different dynamic than McDonald's. And what investors have noticed over the years is that the smaller companies, as a group, they tend to have a higher expected return than the larger ones, which is a great place to start if you want to do better, let's say, than the S&P. Pay attention to some small
Yeah.
caps, but it's exactly the same story in international markets. And then in the 80s and early 90s, there was also delineation among all the small and all the large based on what's called value or growth, which is the price that you can buy a stock given a current accounting fundamental. So the value stocks tend to be lower priced, and over the long run, they have outperformed the more expensive counterparts called growth.